Hello, everyone, and welcome. I'm excited to have you here today. Today's presentation is all about basic accounting terminologies. We'll be exploring some key concepts and terms that form the foundation of accounting. Over the next few slides, I'll guide you through essential definitions and ideas that will help you better understand financial statements and bookkeeping. Let's get started and make sense of these important accounting basics together. All right, let's take a closer look at some of the fundamental terms you'll encounter in accounting. First up is accounting itself. Think of it as the backbone of financial management. It's the process of recording, summarizing, analyzing, and reporting all financial transactions. Essentially, it's how businesses keep track of their financial health over time. Next, we have bookkeeping. This is the daily, hands-on part of accounting. It's the routine task of recording each financial transaction as it happens, whether it's a sale, an expense, or a purchase. Accurate bookkeeping is crucial because it feeds into the larger accounting system. Then there's the ledger. You can think of the ledger as a comprehensive record book or system where all these transactions are organized. It consolidates all the financial data in a structured way, making it easier to analyze and report. Finally, we have the journal. This is where everything begins. The journal is the original record of transactions, entered chronologically as they occur. Once recorded here, these transactions are then posted to the ledger for further organization. Connecting all these concepts, you see how they build upon each other, starting from the initial recording in the journal, then moving into the ledger, and ultimately supporting the overall accounting process. Understanding these basic terms sets a solid foundation for grasping how financial information flows within a business. Now, let's take a closer look at the core financial statements that give us a clear picture of a company's health. First up is the balance sheet. Think of it as a snapshot taken at a specific moment in time. It shows us what the company owns, its assets, versus what it owes, liabilities, and the owner's equity. The fundamental equation here is assets equal liabilities plus equity, which helps us understand the company's financial position at that exact point. Next, we have the income statement, sometimes called the profit and loss statement. This one covers a period of time, like a quarter or a year, and details the revenues the company earns and the expenses it incurs. The key takeaway is that, at the end of this period, it shows us whether the company made a profit or a loss. It's like a report card for the company's operational performance over time. Finally, there's the cash flow statement. This one tracks the actual movement of cash in and out of the business. It's crucial because even a profitable company can run into trouble if it doesn't manage its cash properly. This statement helps us see how well the company is generating cash from its operations and how it's investing or financing its activities. Connecting all these, they provide a comprehensive view of a company's financial health, what it owns, what it owes, how it performs, and how cash flows through the business. This understanding is essential for making informed decisions, whether you're investing, managing, or simply analyzing a company's stability and growth potential. Now let's take a closer look at the key accounts and elements that make up a company's financial picture. First, we have assets, which are simply resources owned by the business. Things like cash, inventory, or equipment that help the company operate and grow. Next are liabilities, which represent what the business owes to others, such as loans or accounts payable. These are obligations that need to be settled in the future. Then there's equity, which is essentially the owner's stake in the company. You can think of it as the difference between what the business owns and what it owes, assets minus liabilities. Moving on, revenue is the money the business earns from its regular operations, like sales of products or services. It's what fuels the company's growth and sustainability. Lastly, expenses are the costs incurred in the process of earning that revenue, things like rent, wages, or utilities. Understanding these elements helps us see the full financial story of a business, connecting how resources are acquired, used, and ultimately translated into profit or loss, which ties right back into the overall health and success of the company. Now, let's take a look at some of the common accounts you'll encounter in a business. First up is accounts receivable. This is essentially the money that your customers owe you after purchasing goods or services. It's an important asset because it represents cash that will come in soon, so managing receivables effectively helps keep your cash flow healthy. Next, we have accounts payable. This is the money your business owes to suppliers for the goods or services you've received. Keeping track of what you owe and paying on time is crucial to maintaining good relationships and avoiding penalties or interest. Then there's inventory. This includes the goods you hold for sale as part of your normal business operations. Proper inventory management ensures you have enough stock to meet customer demand without overstocking, which ties up your capital unnecessarily. Finally, we have capital. This refers to the money invested by the owner or owners into the business. Capital is the foundation for starting and growing your company. It funds your operations and helps you invest in new opportunities. All of these accounts are interconnected, and understanding them helps us see the bigger financial picture. They form the core of what we call the common accounts, which are essential for managing daily business activities and financial health. Recognizing these key accounts is a crucial step in mastering how a business keeps its finances organized and transparent. Now, let's take a closer look at some of the fundamental transaction concepts that form the backbone of accounting. First up is the idea of a debit, often abbreviated as doctor when we record a debit. It typically means we're increasing assets or expenses. For example, if a company purchases supplies, that would be recorded as a debit to the supplies account. On the flip side, a debit can also decrease liabilities or equity, depending on the situation. Next, we have credits, abbreviated as CR. Credits work somewhat in the opposite way. They increase liabilities or equity, or decrease assets and expenses. For instance, when a company takes out a loan, that's recorded as a credit to the loan payable account, increasing liabilities. Moving on, the trial balance is an essential tool we use to ensure everything is balanced. It's basically a report that lists all the accounts and their balances to verify that total debits equal total credits. This helps us catch errors early before preparing financial statements. And finally, the double entry system. This is a core principle in accounting. Every transaction affects at least two accounts. One account is debited, and another is credited, which keeps the fundamental accounting equation balanced. Assets equal liabilities plus equity. This interconnected system ensures accuracy and integrity in our financial records, linking all the concepts we've discussed today. Together, these concepts create a cohesive framework that helps us record, verify, and understand financial transactions reliably and systematically. Now, let's take a moment to look at some other important terms that help us understand financial statements better. First up is depreciation. Think of depreciation as the way we account for the fact that assets, like equipment or vehicles, lose value over time. It's a way of spreading out the cost of an asset over its useful life, which helps us get a more accurate picture of the company's financial health. Next, we have the accrual basis of accounting. This approach records revenues and expenses when they are actually incurred, not necessarily when cash changes hands. So, if you perform a service today but get paid next month, the revenue is recognized now. This method gives us a clearer picture of financial performance during a specific period. In contrast, the cash basis records transactions only when cash is received or paid. It's simpler but can sometimes give a less accurate view of financial health, especially for longer-term planning. Then there's the fiscal year. Unlike the calendar year, a fiscal year is a 12-month period that a company chooses for its financial reporting. It doesn't have to start in January. Many businesses pick a fiscal year that aligns better with their operational cycle. Finally, we have audits. An audit is an independent review of a company's financial statements. It's essential because it verifies the accuracy and fairness of the financial reports, giving stakeholders confidence in the numbers. All of these terms connect to our overall goal: understanding how financial information is prepared, presented, and verified to support informed decision-making.